G'day expats, welcome to another episode of Expat Chat. I'm joined here today by my friend, colleague, business partner, Brett Evans, who is the Managing Director for the EMEA region, and I'm James Ridley, Managing Director for the APAC region. Episode 26. How are you going, Brett?
Mate, all good, thanks. All good. It's, I wouldn't say it's Groundhog Day, but, the sun still rises in the east and sets in the west, and we plod along. And it's been a busy couple of weeks, especially with the budget last week. We've been running, obviously, seminars in Dubai, online webinars. You've got your one coming up tomorrow. So lots to talk about, lots to digest. There does seem to be a lot of concern out there amongst expats as to the new rules. So it's great to put a bit of clarity around that. And especially allay some fears. Social media is great, but it can foster a fire that is unnecessary, in my view.
Oh, absolutely. There's always a lot of concern when some proposed changes come through, and I suppose there's not really enough detail for anyone to make any decisions yet based off what those proposals are through that budget announcement with residency and other things. And unfortunately, when you log onto social media, it can fuel the fear. Nothing's been legislated just yet. It's all proposals, and a lot more needs to come out. Before we jump into it, Brett, do you just want to give that little disclaimer?
That's right. No, all information that you have the pleasure of watching, listening, hearing is for your entertainment purposes only and should not be construed as financial advice.
That's right. Well done. Well, we'll jump into it today. Let's talk about a bit of a market update, how things have been tracking, especially kickstarting for the year. And then, we'll jump into those changes that we're keeping an eye on as part of, residency. So I suppose markets have been very interesting lately. You look at the US market, Australian market, every second week I'm just hearing that we're hitting all new highs, new record highs, which how long can it go on for? It's like this melt up that a lot of people keep saying where, we're going to keep soaring and then there might be a bit of a correction next year maybe.
Look, to me, and we saw, the Australian market today looks like closing down 2%. The index is an index of stocks, not an index of indexes. And there's different companies doing good and bad and different things at any particular point in time. To me, what we're seeing right now, and we did cover this in the webinar and the seminar, so those who were on it will recognise us saying this. Those who weren't on it, you missed a great time. To me, we had a great time. To me, the biggest thing is we're seeing rotation in sectors. Out of the tech heavy growth stocks, we're now going back to value-based, which is fantastic. I've been in the markets for 25 years and I love looking at P&Ls and balance sheets and, PE ratios and stuff. We can measure how expensive or cheap a company is when we look at those sort of metrics. And when we're not looking at Tesla, which has a price to book value of 500 times. Some scary numbers out there.
I like the fact that you just mentioned Tesla. There's an article that came out yesterday. Michael Burry, probably pronounced his name wrong.
Big Short. The guy called the GFC.
That's right. He's actually just put all these puts on shares on Tesla's share price to drop a ridiculous amount because he's pulled apart all the financials, and essentially a lot of their revenue is made up of these tax credits. It's not actually made from sales. And because there's been all these issues with parts and whatnot over in China, he thinks this year their share price is going to go through a huge correction. It's somewhat already happening. You look at where it's tracked for the start of the year, it's gone up and then it's gone back down and sort of tracking down at the moment. It's a bit concerning because so many people piled into it.
Well, the big question is the Reddit crew going to get onto this one and short it as well? I'm not sure where Reddit crew can short stocks, but certainly, I've always, just from a 40,000 foot view, always had concerns about Tesla from the sense of like-for-like comparisons, whether you're comparing it to the tech stocks or whether you're comparing it to automotive stocks. They make 500,000 cars a year, but yet they've got a market cap of 1.5 times the size of Toyota, which is the largest car manufacturer in the world. So I don't know. I've said it on the podcast before, and I'll say it again. I don't know whether people think they're getting SpaceX when they buy Tesla. I just don't know.
Yeah, I know. I mean, I call it the Elon effect, to be honest, where Elon, he's obviously in the news. He's doing stupid things sometimes. And if he's doing cool things tied to SpaceX or his boring company or this whole project with the tunnel, people want to get a piece of it. The only way they know how to get a piece of it is, I'll buy Tesla. That's, that's obviously going to reap some rewards. It's going to be further from the truth. And that's why you've got this big heavy hitter that's swung in with his big, investment firm, and they're obviously shorting the stock now for the next 6-12 months, see how we go. But it's very interesting, especially you learn a lot when you read those kind of articles. The tax credits is very interesting, the way it operates over there in the US. But
keeps
as
the
a whole,
busy, doesn't it?
Oh, it does. Getting very creative, cooking the books maybe. No. But I suppose as a whole, it just seems like we're starting to get back up to speed. There's plenty of stimulus about. I think the scarring from COVID-19 on the Australian front is obviously almost not gone, but it's healed up quite well. But you look at, I suppose, our heavily reliance on, one thing you talked about already was iron ore prices and iron ore with China, always an ongoing concern. I mean, did you want to mention that as well?
Yeah, look, I mean, it's interesting. For every $10 increase in iron ore or decrease, it goes both ways, is equivalent to 0.6%. Or $11 billion US, or 0.6% of the Australia's GDP. So certainly with China taking a very frosty defence position against Australia, we've seen what's happened with coal, we've seen what's happened with lobsters, we've seen what's happened with barley, wine, coal. There's a lot of posturing going on between the two countries. The big question is, will we see that those import quotas or bans with respect to iron ore? Certainly China does want to bite the hand that feeds them when it comes to helping them with their infrastructure projects, but also to, I have heard on numerous occasions that China's stockpiling Australian iron ore. So sorry, China is stockpiling Australian iron ore. So whether they're just getting it now and then they go, okay, we're done, and then they'll use that as a political, I don't know. I mean, only people in Beijing know these things. But look, it's something I'm concerned about. Taiwan scares me. To the point now where China is now flying fighter jets over Taiwan. Taiwan is not scrambling jets in response because they don't want to antagonize them. But it just almost gives China the mandate to say, okay, come on in. If we do see that, obviously we're a military partner with the United States. United States would then say to Australia, stop your exports to China.
That's right.
Because iron ore makes steel makes bullets, tanks, planes, and so forth. So look, I mean, iron ore is at record prices. We saw a big drop the other day, went from $230 US down to 207. And it's back up again now. But the interesting thing is that the Australian dollar hasn't recovered in the same way. So to me, currency traders are taking maybe a risk-off approach. They're saying, oh, this is looking a bit shaky. You can always, the currency markets, the money markets, the equity markets, they're always very good at anticipating problems. And you can sometimes read the tea leaves in terms of what potentially...
Well, they build it in, don't they?
They do. They do. So it's going to be interesting to see what happens in the next couple of months with China, that's for sure.
That's right. And I think as part of those, the updates as well as the recent budget update and the webinars and seminars, talk a little bit about interest rates and inflation and how inflation is a very real concern. And usually, obviously, one thing, you've already mentioned, especially in your seminar and webinars, was we don't want to see a shoot-through effect, interest rates climbing too quickly when the governor of the RBA is saying, okay, interest rates, they should stay as is until 2024. But you've also got this flow-on effect where you've got the property market just going gangbusters because people can go out and buy properties because money's cheap. But have these people accounted for a 1% increase in interest rates? And as you also put... No, exactly right. And, one thing I really enjoyed about your seminar was you talking about, we've got such a large demographic which haven't seen interest rates above sort of your 5 or 6% compared to back in the 90s where your average mortgage was 7.5%, 8%. So very real concern with inflation back in the 90s when we sort of slipped into that recession.
Look, to me, it's going to be a two-step process. The party finishes in June next month with respect to the RBA's funding of banks. So essentially, for those out there who are not aware of this, the RBA is giving them $180 billion to be able to lend out to mum and dads at 0.1% interest rates. So then obviously the banks add on their margin and then off they go. And that's why variable rates are so cheap right now. Once the banks have to start going out to fund those mortgages from the wholesale market, I guarantee they're not going to be paying 0.1%. Compounding that is you've got Standard & Poor's and Moody's putting Australia on a credit watch. If Australia does lose their AAA credit rating, then what it costs us to borrow money at both the federal, state and corporate level will go up. So if we do lose our credit rating, if we go from AAA down to AA plus, that will hurt the banks in terms of how much they can borrow at what price and then what lend at. So whether the RBA likes it or not, they keep saying 2024 we're not going to raise rates to. The banks now are almost operating agnostically to cash rates anyway. They've been doing that for the last 5 years. So whether the RBA likes it or not, the banks may start raising rates, and then obviously if mortgage rates start to go up, then that could certainly start to hurt a few people.
Yeah, absolutely. I think too many people have jumped on this property boom and probably leveraged or geared themselves through the roof, assuming, oh yeah, I've got 4 years to wind down my debt into a comfortable LVR position, loan to value ratio position. But again, interest rates could come a lot quicker. I mean, we already know that, as you put, Canada, it's started to wind back its QE program.
Yeah.
And as a percentage, it's doing that just to sort of probably stem off inflation coming back with a vengeance.
Yeah, I mean, Canada's got a very similar market to Australia. I'll watch Canada closely because what they do is a very similar thing to what Australia does, both as a Commonwealth country, but also as a country that has an economic sector makeup very similar to Australia with respect to resources. So it's going to be, look, I think we've said it for the last 12 months, but it's going to be an interesting 6 months to watch.
Yeah, absolutely. And I mean, we'll kick on from there into these budget proposed changes, and a lot needs to still come out about these changes with regards to the nitty and gritty details. I think one of the major changes that obviously non-residents or Aussie expats are following is this tax residency update, which is, as we know, well overdue. It's going to be very interesting to see what they nut out, but introducing that bright line test, so the primary test, the 183-day test. Did you want to talk about that a little bit, Brett?
Yeah, look, I think there were 3 key takeouts for expats in the budget. First one was changes to the works test, which is no longer applicable from those aged from 67 to 74. Second one is the changes to the central management and control rules with respect to self-managed super funds. Third is the active members test. Now, one thing I just really want to enforce this. These are rules that are proposed to come in 1 July next year if everything goes to plan. If you are out of the country for longer than 2 years now with an SMSF, it doesn't mean you just wait for that new rule to come in, because it may or may not come in, but also to, you may find that your fund is deemed non-compliant between now and 1 July next year, and there goes half your balance. So just be careful of that. But certainly what's captured everyone's attention, imagination, has certainly been the proposed changes to the residency rules. These proposals or the recommendations were made by the Board of Taxation back in 2019. They started March 2019 and they delivered to Canberra in December. And essentially what we've seen out of the budget is a very high level scrape of those recommendations. Now, one thing that's important to say is we won't know the finer details until the explanatory bill is released, which is probably June, July, more likely July. And then it's got to go through the lower house, the upper house, and so forth. But, from a very high level point of view, we're talking a bright line test, 183-day rule in terms of qualifying and classifying as an Australian resident or non-resident. But then there's this new 45-day rule. So do you want to run through that?
Yeah, the 45-day rule is very interesting because it applies to, I suppose, prior years tax residency. So I guess someone that's considered a long-term tax resident, so someone that's, Australian citizen or permanent resident that's been in Australia for, 5+ years, life is generally here, then they've, received an opportunity to go overseas. What they're looking at is this 45-day rule in the previous years, income years before they leave. There's the other sort of factors test, which is coming into it as well, 4 factors. And then there's also this overseas employment rule. So there's a fair bit in it at the moment. And I suppose from our point of view, we're still pulling it apart because, we're still running off the report that the Board of Taxation released back in March 2019, because there's a lot in there. They also mentioned how the changes in tax residency is going to apply to a country that we have a double taxation agreement in place. So, if based on the treaty that we have in place, that other country deems you to be a local tax resident, well, as part of our treaty with any country, you can't be a tax resident of 2 countries. You can't be a tax resident of Australia and that country, Singapore, as an example. So in that scenario, if there's a tie-breaking rule, then you actually might be able to be a non-resident a lot easier based on the local rules. So there's still a lot to come out. That, what we've just discussed right then, that's not even in the budget update. This is directly from the Board of Taxation, a report back in March 2019. The 45-day rule is very interesting because that's what a lot of expats are concerned about, whereby, okay, if they come back to Australia and they're in Australia for more than 45 days, then this can actually impact them resuming being an Australian tax resident. And then that's when it can flow into these 4-factor tests. And you only have to meet 2 of them to accidentally become an Australian tax resident again. And that's why so many people are so concerned, because obviously a lot of expats post-COVID, pre-COVID, we'll say pre-COVID, they would come back and visit family, friends, and they'd be in country for more than 45 days in the same Australian financial year. So the fact that they're now drawing this hard line where, okay, if you're coming back and you're here for more than 6 weeks, technically, in one financial year, well, this could actually impact your residency for that entire financial year. And that's what is so concerning. The update with the primary test, the bright line test, it's mainly to bring us up to date in, I guess, in terms of a modernized, globally mobile workforce, and align us similar to some other countries' tax residency rules, UK as an example. But there is still a lot that needs to come out from this. And I guess if we saw how long it took them to bring forward and implement the main residence exemption that impacted expats, when was that announced? 2017?
2017 budget. Yep, never forget that one.
2017, that's right. 2017 budget received royal assent December 2019. So we've seen how long things can take, especially if some of the changes get enough consultation from other, I suppose, tax consultants on things that need to be tweaked. But it's trying to remove a lot of what-if scenarios and just have a simple test to follow and administer. I know the Board of Taxation released a really good flowchart, but even when you go through the flowchart, there's still some things you're unsure of. I think, as Brett's already mentioned in some of these seminars, the overseas employment rule is crucial. So the day that you're leaving Australia, you should have a contract in place that reflects that you are walking into employment and you've got sort of accommodation over there, those sort of things. And you can essentially, as of that date you depart, the next day you're a non-resident. But again, if there's other things that go into it at the moment.
Yeah, and look, I think also too, the other topic that is capturing a lot of people's attention is the economic assets factor test and what's included in that list. Because essentially in that list, at a very high level, taxable Australian property, so house, apartment back in Oz. Then you've got cash sitting in a bank account.
That's a big one.
It is a big one.
I know too many people have a large amount of cash sitting back in Australia, not doing anything, even though I guess we've always prompted, all right, if you, as a behavioural point, give that cash a purpose. Don't just park it there for months and years. It should be sitting in either an offset account, should be invested, should be paying down bills, should be going to super. When cash is left idle there, well, I guess as part of this new test, it's an economic tie back to Australia.
To me, the big one is and we've been saying this forever and a day, and it reinforces this even more so. And I'll use an example here of Australian expats in Dubai and the UAE.
Yeah, perfect.
The way the tax laws are written, it ignores your citizenship. You need to manage your assets like that of an Emirati if you're in the UAE. Would an Emirati plonk 100 grand Aussie in a bank account in Australia and do nothing with it? No, they wouldn't. So that's the best way to describe it. Now, up until recently, especially up until these new changes are proposed, it hasn't been the be-all and the end-all of qualifying as a resident for tax purposes. But it can open the door, crack that door open enough for the ATO to come in and try and use other things to justify why you should be a tax resident. Now it's codified, it's solidified, it is part of that test. So it's not like it's an onerous thing. We always say to clients, there's sometimes you've got cash sitting in a bank account only because you don't know what to do with it. You sort of you just don't know how to manage your money as an expat. So you're like, I'm just going to put it there until I can work it out. And years go by and money's still sitting there. And, we always talk about it. You don't know what you don't know. And, I think a lot of expats suffer from what we call analysis paralysis, where there are so many considerations as an expat that is like frozen by, I'm not sure what to do. I'm just going to go cash.
Fear.
Yeah.
Yeah, so, well, I mean, it's fear of the unknown. Oh, if I do that, is the ATO going to come after me and essentially say I'm a maybe even penetrated tax resident? But the fact that we've always promoted, active purpose, give the cash an active purpose as a behaviour, well, it's being legislated that if you've got large cash there as part of this economic connection, that could be the thing that swings you back into being a tax resident, which I'm sure you can imagine a lot of expats in the Middle East, tax-free areas, they're going to be
with
dreading.
no DTA, tax-free with no DTA. Yeah, so
absolutely.
Treading that line is going to be, including for myself personally, treading that line is going to be imperative. And it's you hit the nail on the head before in terms of other countries having the same sort of rules. This is not the first. UK, New Zealand is very similar as well too. Our friends over the Dutch. And the biggest thing we always talk about is changes are constant as an expat. So those, and I said this at the seminar on Monday night, looking at the room, I said probably 10% of people are going to be directly affected by this. And those 10% are those who have sort of had a lifestyle that straddled two countries. As opposed to severing ties, moving the family overseas, blah, 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 blah. As long as you don't go back for 45 days or greater than 45 days, you're fine. If you want to be clever, it is 45 days in an income year. So you can put, you can go back 45 days before 30th of June and stay for 45 days after. You can stay for 3 months if you want. You just got to have, you got to lose a bit of flexibility. But if you want the privilege of being classified as a non-resident, you have to have that at the bottom of your heart. Like there is a price of admission being a non-resident now. We've been fortunate up until recently. It's been a bit loose, a bit grey, but now it's coming back to black and white.
Yeah, I mean, the other one that's a concern, or not a concern, but it's just something that's probably overdue, is that Australian family as a factor test, your ties back to Australia. I know many expats where, the spouse is back in Australia, so are the kids, and they're working overseas. They rarely come back. I suppose the main earner or the breadwinner, they're usually overseas for quite a while, but when they come back, they might come back for 3 months, catch up with family, and then they're gone again. So it's going to be very interesting. And when they actually bring this legislation in play and gets royal assent, well, people are going to have to assess their previous tax years that they've been in Australia, look at all that for the factor test, those sort of things. It's going to make it or create a situation where accountants are going to be very busy trying to provide advice on this. It's a tough one. I mean, the Australian family, the economic connection, I think there was one in there regarding discretionary trust, if you're tied to a family trust back in Australia as well.
Yeah, and discretionary trust. And also, on the family side, one thing that I sort of thought of last night when we were doing the webinar was kids at boarding school. Well, technically, they're below the age of 18.
18, that's right, minor, absolutely. So they're still dependent.
Whether Canberra's thought of this, certainly, when they release the explanatory bill, we'll know more details, and if required, we'll submit our own submission as well to Canberra, to sort of take into account these types of nuances, because, there's a lot of day-to-day things that the politicians don't think about that we see on a daily basis, and we get those questions on a daily basis. So the devil is certainly going to be in the detail, that's for sure.
Absolutely. And I think once the AM comes out, we'll probably have to put a submission on change.org, get as many signatures as we can if there's something that needs to be amended to it, and hopefully that does the rounds in the expat forums. But I mean, one of the changes we briefly just mentioned before was we talked about SMSF changes, obviously being a bit more flexible around the tax residency, those sort of things, and the 2-year rule to the 5 years, and then being able to contribute obviously to an SMSF while you're overseas. Obviously, if you're in the US, don't do that because you'll be in a lot of strife. Shouldn't have an SMSF if you're in the US.
Foreign grantor trust.
That's right, don't do it. And then I suppose another change with superannuation as a whole was the ability to contribute, a lot more up until age 74. We don't need to meet this active work test, which honestly I think is great for expats, because a lot of expats, because of the fear of the unknown, if they're working quite late up into their career and not coming back to Australia until maybe after 65, well, they might not have paid attention to their super at all. So therefore their superannuation is unfunded, and they've got a lot of their wealth outside of Australia. With this opportunity to keep contributing up until age 74, it just provides this welcome, I suppose, again, a tax efficient way that expats can finally build up their fundamental Australian retirement asset, which is going to always be in their best interest if they're coming back to Australia. Pretty pumped about that one.
Look, it's good. And, we use super funds for a lot of reasons. And there's this misnomer that if I'm not returning to Australia in the early part of my retirement there, I don't have to worry about super. But I actually disagree. To me, superannuation is a vehicle. And you can convert your accumulation account to an allocated pension account, and you can still be in Thailand. you can still draw from that tax-free. But the biggest problem that people don't anticipate is, normally if they are going to retire early overseas, they are going to go back to Australia age 70. But by then, you cannot put anything into super
at all.
Because, you've already started an allocated pension and so on and so forth.
Not working. Yeah.
Exactly. So to me, more, I guess, education from our point of view and more understanding from an expat's point of view about superannuation accounts, the benefits of that. It's not just in Australia, it's everywhere.
That's right.
We've got clients who've retired all around the world and they're using the Australian super account and they're getting tax-free income and tax-free gains. So,
absolutely.
And we're not even talking Isle of Man bonds or 10-year savings plans.
Yeah. Well, I mean, as a reminder to our audience, obviously these changes haven't been legislated just yet. Yeah. It needs to still be obviously be legislated and receive royal assent. The superannuation changes, they're a welcome surprise, to be honest, with being able to contribute. I can think of off the top of my head 10 clients that will actually be able to use this that are retired overseas. I can't wait to obviously revise those strategies and get them out to them ASAP. But again, we always have to wait till the legislation pieces receive royal assent. The tax residency fund, it is welcome, but there are always a lot of concerns about these factor tests. I think a lot of people actually are going to become undone once it is legislated. But the biggest concern right now is if they bring this into effect, say July 2022, and COVID borders aren't reopened or anything like that. We've still got COVID as it is, which I suspect it will be. It's very difficult because they've brought in this legislation piece where the borders aren't reopened. We might be forced back to Australia, might be forced overseas. The factor test might say, okay, our Australian family can't come overseas with us. It's not really bringing that into, I suppose, light. But I guess the main reason being is, and it's something you mentioned in your seminar, Brett, was remember the Board of Taxation did up this report March 2019 and submitted it December 2019. COVID wasn't even around, didn't exist.
No.
So it hasn't accounted for that yet. So those are some other changes which, again, will need to come into effect. Maybe they'll put it on ice for 2 years until, we've returned to some normality, but I wouldn't hold your breath just yet.
And I think also too, there's a great part of that report that does talk about the ability for you to write to the Commission of Taxation to ignore some of the 45 days. And that's the biggest thing that I took out of that pre-COVID. And right now, with people spending 2 weeks in quarantine, there's 14 or 45. So how that works in terms of, what are we looking at? Scenarios of having to go back to Australia to see a sick family member. They've almost provisioned for that in advance without knowing they had to provision for it because of quarantine and those sort of things. So once again, the devil is going to be in the detail when it comes to that explanatory memorandum.
Oh yeah, absolutely. When it comes out June, July, I have no doubt we're going to be doing a few more seminars and webinars just to
explain,
pull it apart, essentially.
Pull it apart, educate. So,
yeah. I think we might finish up there. One thing I wanted to announce to our US listeners, I'm going to be doing an expat chat with a good colleague of mine, a tax accountant that's going to be talking about all US tax things. And then Brett and I are going to sit down and do another expat chat very soon about end of financial year tips and tricks for expats. So please listen out for that one. And as always, we enjoy you for stopping by.
Yep. And just a call to action, guys, if you could listen to this on the podcast, review and give us a rating. These things are important in order for us to be able to communicate at a scalable way. And as you know, we don't expect business out of this. From us, it's an educational point of view. For some, it's entertainment, but for most, it's educational. And that just helps us in that. Certainly, if you're watching this on YouTube, like and subscribe. That'd be fantastic as well. The more people that do that, the more reach we get and the more education we can provide and hopefully, stop expats tripping over any wires.
That's right. Well, Brett, thanks for stopping by. I'll be speaking to you very soon on the emails. Thanks, guys.
Cheers.
Appreciate it.
Thanks, guys. Take care.
Well, I hope